Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and we have back my friend and great writer, by the way, the CEO and strategist of Quill, Danielle DiMartino Booth. And I don't know anybody that has a better vocabulary than Danielle. But Danielle, we're glad to have you back.
Ted, it's great to be back in this wonderful holiday season. Thank you for having me.
Um, I want to start out a little bit. We'll get around to the Fed and lowering rates and everything that's happened. But let me ask you, you've had the point of view that the economy is slowing, but people don't realize it, or the people involved don't realize it. You might talk about that a little bit.
So, yeah, whenever I visit New York and I'm kind of on this true island of Manhattan, you feel like you're in this kind of intellectual bubble. Uh, there's so much wealth on that 18 by 2 mile island, and people pay such close attention to what the great big investment banks tell them the economy is doing, and they have no perspective on what's happening in the rest of the country. And so markets just kind of trade based on a narrative that is painted for them in many ways. But you talk to working men, you talk to working women, you talk to parents, you look at the small business closings and so much other data that's rich, and you see that the perception on Wall Street has very little to do with the current experience on mainstream. And with a very long lag, we're starting to see that play out in the data through the backward looking prism of revisions.
Well, and you've got some thoughts though on the fact that labor has been weaker than the numbers would have shown. Maybe purposely so. We can be a little skewed on that, probably looking at the government. But I think you think generally, and you've got a graph about how they've overcounted and then had to back out. We'll show it here in just a second. But I think you see that as a trend all during 25.
It has been a trend in 25. And in fact, if you look back to the full year of 2024, if you look on a rolling basis, we were only creating 10,000 jobs a month in 2024. We just got these revisions out a day ago that tell us that this was the case. But what we know was that going into 2025, the economy at best, in terms of net job creation, had stalled. And now we've seen, and in fact, Federal Reserve Chair Jay Powell has acknowledged that we have really seen an arresting of job creation beginning with the peak in April of 2025. And that in fact, we've seen net job losses since then. And again, this is playing out, I guess, to differentiate 2024 and 2025. 2024 was a stall, and it took a long time for the revisions to reveal that. In 2025, we're seeing real-time revisions when payrolls are reported, just looking back 1 or 2 months, meaning the downward momentum has accelerated in the job market.
So let me ask you, in your 2026 outlook, and you've been on this for a number of months now. You see disinflation
Hmm.
coming, and I
And
believe in that report you said you were looking for at least a whole point from the Fed on the downside, having lower rates at least another 1%. Is that right?
I think that is easily a base case scenario. When you start to see a ratcheting up in the unemployment rate that is beyond what the Fed's year-end target is for 2026, as at present day at 4.6%, the Fed is anticipating the unemployment rate dropping to 4.4% by the end of 2026. Ted, that's not usually how these things work. Usually when the unemployment rate goes up, it continues to go up, meaning the Fed is going to be caught off sides and forced to play catch up. After that last meeting, and Jay Powell was as reticent as he was, the market really priced out any probability of a rate cut in January. And lo and behold, data that's been released subsequent to that, now we're pricing January rate cuts back in.
So now you think they'll have to accelerate lowering the rates.
Yes, I think that is a safe assumption, given what we're hearing from from CEOs, given what we're seeing in the bankruptcy cycle, which again, these are all accelerating. And if companies have no choice but to cut costs, that's a nice, cute consultancy word for meaning cut bodies.
Well, and another thing, you know, a couple of the drivers in the marketplace for economics are housing and autos, big drivers. And you have two graphs in your report, which will show one of them. The one of them I wanted to talk to you about was the fact on the housing slump. And the number one thing to look at there is that the sales line is going down, and now it's starting to go down fairly quickly. And
Yes.
wouldn't you think that'd lend to quite a bit slower economy?
Oh, it will. I mean, again, this is the largest input to any inflation metric. So that's where you're going to see disinflation. In the largest sense of the word, we're seeing rents nationwide go down. I mean, Ted, to appreciate that in 2006, 2007, when Bernanke was saying that home prices never decline on a nationwide basis, and they had not since the Great Depression. But think about then the 25 years in this young century and the fact that we're going to see a nationwide housing slump twice in that short span of time. A lot of that is due to the Fed really getting in and manipulating a market that it should not have. So you're seeing greater boom and bust cycles in housing. But that, I think, is where we're headed.
Well, if you talk to builders out here, and they'll tell you that their sales are really slowing now. Now they were stagnant a bit, you know, a year ago, but now they're really slowing. Now they're starting. You're seeing these independent builders. Lennar was down 4% day before yesterday.
Yep,
And
that's right.
even the public builders are starting to get hit really badly. But that's a great graph. We'll show it. But the thing to look at it on it is as the purple line, which is the line that shows sales. Because you can talk about price all you want to. If you're not selling anything, it doesn't make any difference, you know?
That's right. And you've got sellers right now who are kind of pulling their homes off the market in the hope that there's some stabilization, in the hope that mortgage rates fall enough. But as my good friend Ivy Zellman has always taught me, there's one thing that trumps falling mortgage rates, and that's a rising unemployment rate.
Yeah. So with that unemployment rate, you've mentioned numerous times, and we're going to switch over here to the Fed, that they have this dual mandate, which doesn't work out necessarily. And talk a little bit about that, if you would.
Well, so we have to remember the historical context. So in 1977, Jimmy Carter was dealing with a very weak economy, didn't know what to do to resolve the situation. So he said, well, let's put this on the Fed. Instead of just minimizing inflation, let's add maximizing employment as a second mandate. In 1978, that became law, and they changed the Federal Reserve Act. Well, if you think about, I want to keep prices as low as possible. That's one of my goals, but I want to run the economy hot at the same time and keep employment as high as possible. They're inherently contradictory mandates. But Ted, that doesn't take away from the fact that that's the law, and that is what the Federal Reserve is obliged to do. It's obliged to adhere to both of its mandates. And right now, I think most Americans would tell you that it is certainly failing on its employment mandate. And to the extent that there's inflation that is still very crippling for many households, we're talking about a data center in your backyard making your utility bill triple or your food bills high. These are not the sorts of inflation that the Fed has any control over.
Well, I think if you went back and could talk to Milton Friedman, he would tell you that, hey, let's just go with inflation, the money supply.
Absolutely.
We don't need to be looking at unemployment. It'll take care of itself.
And it will. And in times of distress, it's the job of Congress, not the Federal Reserve, to do something to help alleviate stress in the job market. But again, you're absolutely right. It is the private market that it's the job of the private market to set the tone of the labor market, not the Fed.
Well, and if you look back over the last 30 years, it seems as though, it always seems to us, which we're not a big fan of the Fed, I'll have to say that, but it looks as though they've really relied on controlling the stock market.
Yes,
and that was not one of the things you're supposed to do.
It's not. No, and in fact, Ted, you mentioned the thing that is the key driver of monetary policy, of Federal Reserve policy, widening the inequality gap, has been the Fed's focus on the stock market, which has made the top 10% wealthier. It's certainly helped people in your orbit. It's certainly helped my clients, but it hasn't. But it's also forsaken the fact that the Federal Reserve is supposed to make monetary policy in the public interest and for the public good. And it really is only making monetary policy for the top 10%. No wonder they account for more than 50% of consumption. All of the riches are flowing to them.
You know, Danielle, nobody seems to care, though.
You know, Ted, I care.
Yeah.
I really do.
I
And
do
I think,
too. I mean, I grew up poor, so I know what those people are feeling.
and you know, the reason that I quote Abraham Lincoln at the beginning of my 2026 Outlook, and the speech that he gave in 1858 when he won the Senate seat that he did that became so pivotal, is that he recognized that a house divided will fall, which comes out of not one, not two, but three books in the Bible. But he recognized that, and I don't know that the Federal Reserve, I don't know that politicians recognize how divided the House is, because people are so dismissive of the plight of American working men and women.
Yeah. And it's almost as though you have you're not in a civil war, but you certainly have a 50-50 look at the United States right now. But let me ask you on the Fed, there's a lot of talk. All they're always talking about, putting in a new Fed head chairman or chairwoman, and people think it's a big deal, but you don't think it's that big a deal.
I really don't. I published what I called my manifesto a few weeks ago, and just because something's never been done does not necessarily mean that it cannot be done. And my whole point was, regardless of who is going to be nominated to replace Jay Powell as of May of 2026, it is written into the Federal Reserve Act that all 19 members of the Federal Open Market Committee at the first meeting of the year, which is January 28th, they vote for the chair of the Federal Open Market Committee. They could vote in Stephen Myron if they chose to do so, but his term is going to be ending. I say that to make a point. They could vote Jay Powell to be chair of the Federal Open Market Committee for the calendar year of 2026. And his term technically does not end as a governor until January of 2028. Boy, would it get in President Trump's craw if he had to deal with seeing that man behind the podium for the next 12 months of his life. But it's perfectly legal for the FOMC to do that. So we shouldn't be gnashing our teeth at who is going to be appointed chair of the Federal Reserve Board, because that can be a different individual than the Federal Open Market Committee.
But on the interest rate situation, going lower or higher, it's a net vote situation, right? It's not.
It is.
Right. Okay. That's what I always thought.
It really is. Traditionally speaking, the chair has always been able to corral and bring together and find unity on that committee, and in a sense control the vote. But Paul Volcker himself had mutiny on his FOMC. This was close to the time that he left office, but there was no reason that you couldn't even have a split vote on the FOMC in at the conclusion of any meeting. And so that means that one person's only going to have effectively one vote if they don't have the confidence of the others on the committee.
Well, I think if you look back over the last 30 years from Greenspan on, this rich get richer, poor get poorer situation, it's gotten exacerbated all along. But I guess my question to you, Danielle, is if you could fix the Fed today so that they did what they should be doing, what would you do?
Well, I would humbly ask Congress to take the employment mandate back and place it to wherever it lived before 1977. I would be very honest with the public in saying that zero interest rate policy was a failure, that only fed speculation that increased the wealth of the wealthy. And I would say that quantitative easing was also a failed experiment, and that even though there might be a period of transition, that going back to controlling inflation with only the lever of interest rates would be the best path forward to get the economy in a place where it could achieve escape velocity, as economists like to say, on its own, without whatever it is they need from the drug dealer, the Fed, to use a metaphor.
Well, do you think there's any chance that that they get all caught up again like they've done before, and the markets were to fall off, that they would even think about going back to a quarter point Fed funds rate?
I do think that it's conceivable. And actually, Ted, you bring up why every time it looks like the president is imminently going to be naming the nominee to replace Jay Powell, he seems to step back. And the reason he's stepping back is because all three of the candidates have publicly, I'm talking about Kevin Warsh, Kevin Hassett, Christopher Waller, none of those gentlemen are advocates for quantitative easing or zero interest rate policy. And so, if the final question in the Trump interview is, if push comes to shove and we need zero interest rates, are we going to go there? And their answer is no. Well, then he has to call Treasury Secretary Scott Bessent and say, well, we're back to the drawing board. We need to find a yes man or woman.
Yeah. One of the things is that if, our at Oxbow, what we really felt like the next decade would generally be a higher level of inflation. That doesn't mean you can't go up and down along the way, but we felt like if you go through this period, like you're talking about, where they really lower rates or really get aggressive for some reason, the pain of that would be a year later, or maybe a year and a half later, where you go back the other way. Does that make sense to you?
Well, look, now we actually get back to the thorny issue of politics. If you think about 2028 and the pendulum potentially swinging all the way back to giving people helicopter money, giving people cash. I mean, what am I saying? The current administration is discussing the same thing. But if we get to the point where policy will only benefit the wealthy, and therefore the fiscal authorities have to hand cash out to the people, we'll have the worst of both worlds, because that is the type of policy that generated the double-digit inflation that followed the pandemic.
Yeah. So and you look at the markets every day, but if thinking about where we are right now, okay, and if you could sit somebody down and give them some advice maybe on how you think they ought to think about investing over the next 6 to 12 months. Have you thought about that, or given any thought to what you might say?
So I think there's something to be said when you're starting to see big headlines that call into question the AI trade. And I'm not speaking about the technology itself. 12 months ago, we would have been talking about cash flow and profit, basically being the engine of growth for AI. But 12 months later, we're talking about debt being required to push that AI trade forward. The reason I bring this up is I think that the air is coming out of the AI bubble. I think that demographics being where they are with falling interest rates, I think baby boomers are going to be much more focused on income going forward, as they're making less on their cash investments that they've really enjoyed. They loved that when their 12-month CD rate was 5% or their money market rate was 5%. Now that it's going to be much closer to 3%, Ted, I think we're going to see investors looking for steady income streams, dividend paying stocks, truly good credit corporates, and you know what, treasuries as well.
Yeah. So in that vein, and I'll mention this just a little bit because people haven't seen it, they're watching this, but you wrote a letter to the Fed, an open letter, a manifesto, I guess you'd call it, about, what was that, 8 or 10 days ago?
Yes, it was. Mm-hmm.
Okay, and I read it, and I think what you were saying to them is, if you can't get independent, then you're creating this problem with the lower half of the country. Did I read that correctly?
You read that absolutely correctly. I provided a very simple blueprint for the Fed to ensure its independence on its own regardless of what happens in the White House, regardless of who's chosen or nominated. So, but my point was, it is exactly what you brought up. You cannot complain about your independence being impaired if your independence is in your control. So retain control of it by shifting how you've operated. Just because it's something as a tradition does not mean that it needs to be set in stone. Maintain control of your independence, and for heaven's sake, make monetary policy for every American, not just the people on the island of Manhattan.
Where do you think it all ends with this lower 50 or 60% of the group of the economy? Where do you think that all ends?
You know, Ted, I hope it ends in a good place. There are some good individuals who have the fortunes and the futures of all Americans at heart. I hope we start to listen to them, because it's going to take more than anything else. And again, this is why I opened with the challenge that was facing Abraham Lincoln as the country was dividing. There are people out there who want to see this country reunited, and there are great Americans. And I think that we have to focus on finding new and fresh leadership who does not want to divide, but that wants to unite.
But you know, Danielle, if you look at public companies, I'll use those as an example. It's all about making the top management group wealthy.
Mm-hmm.
You know, you bring in a new CEO, president, they stay 5 or 6 years, they make you 100 million. They hand the pawn to one of their buddies. I think that's a problem, and if you look at CEO pay relative to the average worker pay, we're so far off the mark relative to the rest of the world. It's crazy.
It's ridiculous. It's an insult to their employees. It's
But
an affront.
they don't seem to change, though. What I'm saying is,
They don't change, but Ted, we could change the law under strong leadership. We could outlaw stock buybacks.
yeah.
And stock buybacks is how they manage to get earnings per share to rise so much, which is what their bonus is based on. Just take away the candy jar.
Hey, you're preaching to the choir on that one.
Yep.
I've always thought that it's a racket.
It's a complete racket, because it's all about earnings per share. Well, they say, well, I don't know, why don't we just make the denominator smaller by buying back a whole bunch of it, and that determines my bonus. And you know, as the company continues to flounder because I don't treat my employees correctly, I'll just look for my next CEO position, and I'll jump ship and go to my next one and make my next 100 million.
Because I could show you many companies that the revenue for the last 5 years is even, it's flat, but the stock price has gone up because they've rigged the lower number.
Mm-hmm.
And of course, it's the same thing though. And I noticed something last week that said that CEOs are they're jumping ship now faster and faster and faster. And I think that's because we make them wealthy.
Oh, certainly. We don't make them accountable. We don't make them earn out their performance over time. We set their performance based on monkeying with their balance sheet and financial engineering and buying back. May he rest in peace, Arthur Cashin. This was one of his biggest hot buttons, and he saw it over his 50-year career in the stock market, was that they weren't really working for shareholders anymore. They were working for themselves.
Yeah. Art, he went back to Payne Weber days, didn't he?
Oh, yes.
He's a good guy. I met him one time, but yeah, I think that's one of the problems though, because a lot of people are tied to public companies, and yet the workers are just barely getting by in a lot of cases.
Look, Ted, if we got rid of insider trading in Congress and share buybacks, that would solve many ills with just 2 small changes.
Yeah. Well, you remember back, I guess before mid-'80s or something, you couldn't do that.
Well, exactly.
I don't know what the date was, but I know it existed.
In 82, share buybacks were allowed. And I don't know whoever let Congress inside trade. That just, I mean, you can't even say the sentence without saying that's ridiculous.
Yeah.
And yet it's allowed.
But I'll say it again. I don't know what causes a change here, but nothing's ever done about it. I mean, we can talk about it, and we've written about it also, but nothing, it's like we have a sort of a surf system or something where, the rich are up here, particularly the rich in power. I'm going to say public companies, Washington, D.C., and down here, you just have people, just barely getting by. I know your friend and mine, Mike Green, talks about $100,000 being the poverty level. That's probably pretty close if you've have to have child care and everything else you put together with that.
Oh, absolutely. Look, the work that he's done is extraordinary. And when you look at again, the Federal Reserve never had any business buying mortgage-backed securities. The Federal Reserve never had any business making housing affordability as terrible as it is. But when you add up the basic costs of living, just the roof over your head, the food on your table, the car you drive, for heaven's sakes, 100,000, that's why our birth rate's fallen so much.
Well, it was interesting to me too, Danielle, that he got a lot of backlash on that article, but it was mostly from wealthy people.
Oh, yes, it was. That was quite the hornet's nest. And he really rattled the establishment because you mentioned the word serf. It's in this country, it either pays to be wealthy and powerful, or it pays to make less than $39,000 a year so that you can live on the dole and never work. But if you want to be an honest American worker, you're going to suffer, and there's something wrong with that.
In today's Wall Street Journal, and I would recommend people read it, there's a great article written, an opinion page by Phil Graham on what's wrong with the welfare system. And he said, if we just didn't have a system, everybody in that program, we'd give them $72,000 a year, straight out, and they could do what they wanted to. But if you think about all the ways they've broken that up and messed it up, we're spending all that money when we could just give everybody a check and spend the same amount of money, and they'd be better off, and we would be too. It's a great article, though, if people want to read it.
I mean, the way this, I think there are 81 or 80, there's some crazy number of social safety net type of programs. And of course, anybody with bad intentions can figure out how to game all of them. They're riddled with fraud. It's just, you're right. We just need to keep it simple.
Well, I'm going to wind up by asking you to give me some bullet points on your 26 outlook, because I know you're looking for disinflation, lower rates. And I'm going to ask you to put in there what you think about the economy, because somewhere along in there, if it gets bad enough, you're going to have the stock market fall off some. But what would be your top or 3 or 4 things out of that report you just put out?
So we do see material risk going forward. If the Fed has to become aggressive in its rate cutting campaign, the stock market will wake up. And whatever bubble that we're in, and I'm not speaking of a bubble in stock prices, but I'm saying a mental bubble that will have to be pricked, and the reality of recession will set in. We will finally see credit spreads gap back out. I think that's going to be a big story for 2026, and people should have that on their radar. And we should also be mindful of the fact that a true recession means that whatever games we've been playing of extend and pretend in commercial real estate and in residential real estate, that's all over. And then we get to something called price discovery. So again, people have to understand that right now they're applauding the Federal Reserve potentially cutting rates at a more aggressive path, but they need to think through what that means for the macro economy, for the banking sector, for the commercial real estate, for high yield bonds. And once they think that through, they might stop and say, maybe we want it where the Fed's not lowering rates as much.
Yeah, I found it interesting that Goolsbee didn't want to cut. He didn't want to cut,
for heaven's sake, Ted, I'm not even going to touch that. That was the most political thing I've ever seen in my life.
I thought it was too. It was
blatantly political. It was his last vote, because the Chicago Fed and the Cleveland Fed, they vote on every other month. Every other year. And that's just because in 1913, when they created the Federal Reserve Act, Cleveland and Chicago were massive economic power centers in the United States. They're no longer. But every other district bank votes every third year. But Goolsbee knew that this was his last time to get a dig into Trump, and he was just as obvious as could be. Everybody knows the Chicago Fed's the most dovish on the planet. It was blatantly political, and everybody agreed that. Agreed.
I guess they're all political in their own way.
Well, you know what? Shout out to Christopher Waller, because I think all of the names being bandied about, I think he's the least political of the bunch, and I think that he would be the most balanced and solid leader for the Fed going forward.
Well, listen, thanks so much. I mean, I think it will be interesting to see because you're right on the front page looking for at least 100 basis points down, and you've been always good, so I wouldn't go against you on that. But it'll be interesting to see if they follow through. But as always,
we're calling for 4 interest rate. Just for the record, we called for four cuts in 2025, and people thought we were nuts, and we got 3 of the 4. So I'm not that crazy.
Well, we have on this screen how to get in contact with you, and I would say to people, I really don't know anybody that's more prolific writer than you are. You cover a lot of territory every week, and if somebody really wants to stay up with that, you're a good source for that.
Well, thank you, and you're right. I think I write in my sleep at this point.
All right, Danielle. Well, listen, good to visit with you. Hope to see you next year, though.
Likewise, and happy holidays, Ted.
Yeah, same to you. Goodbye. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.